more on everything to do with mortgages. And on this channel, we do everything to do with mortgages. And yeah, I'll just get into the meat and potatoes of this part. My name is Faizal Garasia, and I'm with Dominion Lending Centers Mortgage House. I'm a mortgage agent. Couple of things before we get going. Live best practices. A quiet place. Headphones are great. Silent mode on your phone is ideal. Not multitasking helps you focus. Sitting down also helps. And staying present will let you, sort of absorb information that is good for you. Understanding terms related to mortgage. That's the topic today. And thank you for attending our live. This presentation will take approximately 10 to 20 minutes. Please ask questions in the comment section. I will answer them at the end of the presentation. At the end of live, you will learn more about the terms related to mortgage. And as we begin, I would like to say thank you to Gillette, who put this presentation together. And yeah, the live as well. She's here for the last time, and then I'll be able to do this on my own, hopefully. So connect with us. That's our social medias, phone number, call, text, Facebook, Instagram, TikTok, website, everything is there. And you can also download right from there on the website, faizalgarasia.com. The link is available. And yeah, it's easy on your App Store, on your Google Play, both. Understanding terms related to mortgage. So buying a home is a very big decision. For most Canadians, it's one of the biggest decisions, unless you're buying a business and so on. You're going to the next level. But for many clients, buying a home is a big deal. So with that being said, mortgage, understanding mortgage, because when you buy a home, you need a mortgage, most of us. Understanding the terms that come with mortgage is critical. With that being said, mortgage is a type of loan used to buy a home or other property. A mortgage allows the lender to take possession of the property if you don't repay the loan on time. How long does it take to pay off a mortgage? The most common options for an amortization period available for a home buyer on a mortgage are 10, 15, 20, 25, and even 35. Some lenders have come up to 35. Because of the home prices and income ratios, many home buyers have opted to a 25, 30, or even 35-year repayment plan. And all the information here has been sourced from a reliable source. There are terms that are generally reflected on your mortgage documents. They are principal, interest. The principal is the amount of money you buy. The amount of money you borrow. The higher you pay upfront or down payment, the lower principal you have to borrow. So a 500,000 home, if you put 25,000 down, your borrowing is 475 plus insurance, of course, because it's less than 20%. But when you borrow, let's say, if you have a down payment of 100, now you're only borrowing 400. And at that point, which it becomes a conventional mortgage, you're allowed to even stretch it up to 35 years. And that gives you much lower mortgage payment. So there's a bit of a difference, and principal varies from homeowner to homeowner because down payment varies homeowner to homeowner, and the amount of principal is directly connected to the down payment you have. Interest, the cost you borrow, the cost you pay to borrow funds from a mortgage company is called interest. It usually appears as a percentage you borrow. So, typically, like right now, the rates are going anywhere from I would say mid 4 to mid 5s, somewhere in between. And I'm just, since this is a live, I'm just giving a brief range, but that's really where it is. Taxes. When you own a home, you are obligated by law to pay taxes, property taxes. Not your income taxes, those are separate. This is property taxes. When you own an asset, a property in Canada, you're paying something called as property taxes to municipality, local. So that's one. Homeowners insurance. When you have a home, you're obligated to protect it with homeowners insurance for anything that happens with the home. And then if you are putting down less than 20% for down payment, you will also need something called as mortgage insurance, which is what I was talking about earlier. If you put, let's say, 25,000 down on a 500,000 home, your mortgage is supposed to be 475, but it will be higher because there is a mortgage insurance that gets added to the principal. Now, there are 4 C's. So that's enough. That's about the terms, right? Up for mortgage related. Like you'll see these things on a piece of document or some document somewhere on the mortgage terms, conditions, so on and so forth. When you get into the nitty gritty of it, when you're going for a pre-approval, there are 4 C's a mortgage company looks for. One is capacity, second one is collateral, the third one is capital, and fourth one is credit. Now, I'll go back to it. Capacity is mortgage lenders will consider your capacity to pay back the loan. Mortgage lenders will look for your income, employment history, savings, monthly debt, so on and so forth. They also look for sources of income, stability, so on and so forth, to make sure that you have the capacity to borrow. That's what they're looking for. Collateral. For example, let's say someone who just graduated and started a job a month ago. Do they have the capacity to borrow a 25-year mortgage? No. If they are out of probation, will they have the capacity? Most likely not. They just graduated. However, let's just say someone has gone through, a few years of experience and now want to borrow, take a mortgage on to buy a home. The lender will consider, because they have shown that they can hold a job for a few years now. Mind you, that's not necessarily the requirement every single time. There's lender that wants a couple of years. There are lenders that will also do at 6 months mark, 3 months mark. It really depends from mortgage company to mortgage company. Banks want much higher. There are mortgage companies that want much less. As long as certain variables are there, they will accept your capacity. Collateral, the value of the property and other possessions that you're pledging. So value of the property, really, that's what it comes down to when you talk about collateral in the context of a home and mortgage. So is it a detached home? Is it a condo? Is it a townhome? What is the actual property? So let's say, knock on wood, you can't make the payments to your mortgage. What does the lender have that lender will be selling to collect their funds? And is that a marketable property? They're looking for that particular term for when they're doing the assessment. The next one is capital. Lenders consider your readily available funds, which is savings, investments, cash, any other properties you own, as part of capital. Your income is the cash flow. However, your capital is your savings. Down payment is an ideal example. RSPs, investments, There's a whole lot. Client mortgage companies are looking for some sort of a trend where you have the habit of saving and you've saved some. Um, credit, credit score, history. Have you defaulted on your last payments? Are you paying your phone bill on time, your car bill on a car payment on time, your student loans on time, things along those lines. They want to make sure that you are an individual that respects their debt obligation and is making the payments as agreed. Because remember, the mortgage company is now going into an agreement, like looking when you do a pre-approval, that's what really it is. Your mortgage company and you as a client, you're coming to an agreement. Now the mortgage company is coming to an agreement with you and want to make sure that they will get paid. Uh, in all honesty, mortgage lenders, mortgage companies are not looking to take on your home. It is not in their best interest. They are looking to make sure that your monthly payments are being covered. That's really all they're looking for. They are more interested in their interest payments and the cash flow that comes in from lending you the mortgage than anything else. As long as you pay them on time, they're okay. Conclusion. We're at the end of the presentation. Buying a home it comes with great responsibility and a long-term commitment, especially when you get a mortgage. Mortgage requires years before you can settle. Being consistent on your mortgage bills is the key to a smooth duration of paying off your mortgage, and it is a fact. Our goal, my goal, is to provide you a mortgage with the lowest interest rate and help you reach your home financing goals. Well, I should say home goals, because really, without a mortgage, there is no home. And yeah. With that being said, this is my last slide. Connect with me, call, text, Facebook, Instagram, TikTok, website, download the app, whatever way you would like to connect, it all comes on my phone. If you have any questions or concerns, best way to connect with me is a phone call. Just call and I answer. Thank you again for everyone being here. I appreciate your presence and I appreciate your support. If you like this live, it will get posted on, like, after the live is done, it shows up on our YouTube. Once, if you like this live, please like our channel, my channel, and there's lives that I do from time to time. I will be doing a Q&A live soon, just to answer any questions. And I may do that very, very soon on one of the weekends where, yeah. So if you have any questions, feel free to reach out. 416-825-0142. With that,